Okay. So when we talked about sampling, I said last week that there are two types. We have attribute sampling and we have variable sampling. And attribute sampling is exactly what as it is indicated. It is sampling of an attributes, right? So we use attribute sampling with internal controls. Why? Because with internal controls, what we're looking for is the attribute there or not, right? If it's not there, it's a deviation or an exception, right? So controls, when I'm looking at cash disbursements, do I have evidence that the voucher package includes a receiving report, a purchase order, and vendor invoice? Yes or no? That's an attribute. Do I have, when I'm looking at that cash disbursement, do I see or find evidence that the voucher package was canceled upon payment? Yes or no? So we're testing attributes, right? So that is why we use attribute sampling when we're testing internal controls. Variable sampling, on the other hand, we're looking at the dollar value. We're looking at the amount. So that's what we're using variable sampling when we're testing things like accounts receivable, accounts payable. Jimmy?
So I guess you see this as like a qualitative versus quantitative way?
Yeah, that might be a good way. Did everyone hear Jimmy? Yeah. Okay. Right, that's a good way to look at it, right? Okay, so variable sampling, so we talked about internal controls and we talked about attribute sampling. So variable sampling, as I said, is used to estimate the amount or the value of a population. It is related to our substantive procedures that we perform, so substantive procedures related to testing account balances, such as estimating the account balance or a misstatement, comparing the account balance or misstatement recorded with your tolerable misstatement. Remember, your tolerable misstatement is based on your planning materiality, right? So back in the planning stage, when you set your materiality amounts, you allocated your overall planning materiality to various accounts, such as accounts receivable, such as accounts payable, right? And that was your tolerable misstatement for that account. And so when you're estimating that account balance or misstatement, after you perform your procedures and you evaluate your results, you're going to compare that to your tolerable misstatement to determine whether or not you can rely on the amount or draw the conclusion that the account is not materially misstated. There are two types of variable sampling approaches: monetary unit sampling and classical variable sampling. We're going to focus, I'll briefly mention what we mean by classical variable sampling, but our focus is going to be on monetary unit sampling. Excuse me. Same approach in terms of sampling. You have to plan your sample. You then perform your sample and evaluate the results. So similar to when we talked about attribute sampling, same approach. Documentation, right? We have to document our samples. So we need to know what the objective of the audit is. What is our objective in this audit test? And in this case, with variable sampling, is we want to determine that the account is fairly stated in accordance with generally accepted accounting principles. What's our characteristic of interest? What are we auditing? What is the recorded value? So instance in which the audited value differs from the recorded value, right? That's the misstatement. So we have to define what is a misstatement. And let's say for accounts receivable, what would be a misstatement for accounts receivable? First of all, what audit procedure would you perform, and what would be the misstatement after performing that?
The audit procedure would be balances or transactions.
Right, so you're looking at account balances, so that's the category, right, that you're looking at. But what audit procedure, what audit test would you perform? You're testing existence. What do we normally test? What's a procedure associated with existence for accounts receivable? No, that's another assertion related to transactions. But the audit the actual audit test. Right. You confirm accounts receivable. So that's your audit test. So if you define, if your objective is to determine that accounts receivable exist and that it is, the amount recorded is fairly stated in accordance with generally accepted accounting principles, right, GAAP, and you now want to, and your characteristic of interest is you're trying to determine if there are any misstatements. You perform the audit test. The audit test is to confirm accounts receivable, right, and what would classify a difference. If accounts receivable is recorded at 10,000 and you got a confirmation back that said 5,000, that's a difference, right? So you're looking, your test is trying to determine that accounts receivable exists and the value at which it exists. That's one test anyway, right? So if there's a difference from the recorded value, you're going to note that in your test of accounts receivable, right? You're going to note that the book value says 10,000 for this receivable and the customer confirmed back that it's 5,000. Right? So that's going to be considered an exception. Define what the population is. Completeness is important. So in staying with the accounts receivable, you're going to look at the accounts receivable trial balance and you're going to perform tests to ensure that the accounts receivable trial balance is complete. So in testing the relationship, think about the relationship between transactions and the balance sheet accounts resulting from those sales transactions, in this case with accounts receivable, right? So you perform tests, so you know something about accounts receivable transactions that have impacted accounts receivable because you've audited sales, you've audited revenue, right? So you're going to also see that there's a reconciliation process, that the client on a monthly basis reconciles the accounts receivable subledger or trial balance to the general ledger. Right? So you're going to perform tests to ensure the completeness, and then you decide whether you're going to use monetary unit sampling, which is looking at sampling from the dollars comprising that account balance, or variable sampling, which looks at individual components or transactions from comprising that account balance. So once you define your population, now you select your sample and you perform your audit procedures. Same thing, you have to determine what your initial sample size is. Remember what our criteria be: sampling risk, the risk of incorrect acceptance, your expected misstatement, your tolerable misstatement, which you determined when you did your when you determined materiality, planning materiality, and then select the population size, recorded account balance. Select the sample and measure. And in our case, the substantive procedure that we were performing with the accounts receivable is to confirm accounts receivable. Then if we don't get all the confirmations back, what do? Do we consider that a difference? Why or why not? If a customer does not return a confirmation, is that a misstatement or a difference? Why or why not? Oma.
Have your estimated level of returns or not? If it's like, so you have 5%.
No, I think you're jumping ahead a little bit. So let's just talk about, now we're performing the audit procedure. The audit procedure is we confirmed accounts receivable. We sent out hundreds of confirmations to customers. We got back 90% of those. So let's say we sent out 100, we got back 90. There are 10 that we didn't get back. Is that considered a difference? Because we didn't get it back, does that mean that there's a difference in the recorded value? Why? That's right, it's not. Why is it not? You don't know. All you know is you didn't get a confirmation back. Vivian.
Isn't it because it's not guaranteed that the customers will send a confirmation?
Right. The customer is under no obligation to send us a confirmation. That just makes our job a little bit easier, right, as auditors. That if the customer, if we send out a confirmation and the customer returns the confirmation with no differences, we could check the box and say, okay, this accounts receivable exists, right? If the customer doesn't send it back to us, that doesn't mean that it's an exception. It doesn't mean that the customer doesn't agree with the amount. So then what do? When the customer doesn't send it back to us, what do? Is our testing complete at that point? What do? Right. So we do additional audit procedure because we're still auditing accounts receivable, right? So you can't. So my point is, you can't just, if your test is looking at sending out confirmations, okay, and if you don't get all the confirmations back, that doesn't mean it's an exception. Right. You now have to perform alternative procedures, remember? Alternative procedures, and in this case, alternative procedures when we don't receive a confirmation back, is that we look at subsequent cash receipts, or we look at shipping documents and customer invoices, those types of things, right? So we perform alternate procedures on that sample, in that case, and then we look at, after performing all of our audit procedures on that account, then we're going to evaluate, we perform the appropriate substantive procedures. Now we calculate the actual misstatement. So we look at any differences that the customer identified in the confirmation against what the client has recorded for that customer in the accounts receivable trial balance or subledger. We look at, if we didn't get a confirmation back, we try to look at subsequent cash receipts. And if we see that there are subsequent cash receipts, then there's no exception. If we can't find evidence to support that, or if the evidence that we do find differs from what is recorded, then that's considered a misstatement. So, and notice the term, it's not an exception, it's a misstatement, right? Because we're talking about account balances. Now, we do have to determine if it's a material misstatement, but it's a misstatement at this point. Look at the audited value, which is the information that the auditor has gathered from the audit procedures that they performed versus the client's recorded value, right, to analyze the misstatements, the amount of misstatement. In evaluating our results, so the last part is, now we performed our audit procedures, so now we've identified where the recorded value differs from the audited value. Then we look at evaluating what's the problem with the actual misstatement, right? And we have to determine, do we have a representative sample, right? So this is where the auditor's judgment comes in. Do we have, first of all, if you planned your sample correctly, you should have a representative sample. You might need to adjust your actual, you need to adjust your actual misstatement to control for the risk of incorrect acceptance, right? So you want to make sure, because here's your risk with incorrect acceptance. That means that you've accepted the results and they really don't apply, right? That you're going to incorrectly accept, so that you've increased the risk of misstatement if you have not planned correctly and evaluated your results correctly. And similar to when we talked about the attribute sampling, you have to calculate an upper limit on your misstatements, your upper limit on misstatements, and compare that upper limit on your misstatements to your tolerable misstatement that you calculated in your planning, when you calculated planning materiality. So that, because ultimately what you're trying to do is evaluate whether or not the account contains a material misstatement. What happens if it contains a material misstatement? What is that? What do? Do you qualify the audit opinion? Why or why not? Let's start with, when wouldn't you qualify the audit opinion if you found a material misstatement? When would you not qualify? Not the client.
Well, yeah, you leave the client.
Well, you don't have to leave the client, but okay, but you're on the right track, right? So if if you find a misstatement, then you propose an adjustment to the client. Right? You give more than a day, but they have to do it before you sign off on the audited statements, right? So you give the client, you say, here are the proposed adjustments, and the client, if it's a material misstatement, the client should book it. It's as simple as that. If it's a material misstatement, you can't give them a pass and say, okay, right? Because basically your opinion is that the financial statements are fairly stated. They're in accordance with generally accepted accounting principles. So you would require the client to make an adjustment. And if the client makes the adjustment, then the books are no longer materially misstated, or the account is no longer materially misstated. However, if the client refuses to make the adjustment, then you can't possibly sign off on that audit, right? Because the account contains, the financial statements contain misstatements. If a publicly held company, you go to the audit committee, so you would go above management and bring it to the attention of the audit committee. If the client still refuses and the audit committee is just ineffective or not supportive, then the auditor they can't issue an opinion that's saying that the statements are, the accounts are fairly stated. So they would issue either, depending on the severity of it, we'll talk about that a couple of weeks, but depending on the severity of it, they'd issue an adverse opinion or they'd issue a qualified opinion. Or they'd withdraw from the engagement, depending on the severity of it. But in any event, a misstatement has to be corrected. If it turns out that it's an immaterial misstatement, then it's not a big deal. Right? So monetary unit sampling. Monetary unit sampling, basically you're defining the sampling unit as an individual dollar in the account balance. So for our purposes, we're looking at US dollar, right? So you're going to define the sampling unit as the individual dollar in the account. The auditor then selects individual dollars for examination. So if we're talking again about accounts receivable, the individual unit would be the customer account. Right? Because think about it, you have hundreds of thousands, you could have hundreds of customer accounts. The auditor is probably not going to, look at all of them. So they're going to have a basis to select the accounts that they do look at. If we're talking about inventory, for example, it would be in inventory items. Some of the advantages in using MUS is it results in smaller sample sizes, right? Because you're selecting individual accounts, you're selecting particular items. It includes transactions or components reflecting larger dollar amounts. It's effective for overstatement errors, and it's generally simpler to use than classical variable sampling, which is why you see it being used quite often. Disadvantages is it provides a conservative estimate or a higher estimate of misstatement. It's not effective for understatement or omissions, right? Because let's think about accounts receivable. If a customer, if the company has a lower amount recorded on their books for accounts receivable, let's say they forgot to, there was a breakdown in internal controls and they did not record a shipment to a customer. So it's not going to be in the balance, right? It's not going to be in the accounts receivable balance because they didn't record the shipment and they didn't record the revenue. The likelihood that a customer is going to come back and say, oh, no, we owe you more than that, is probably smaller than if a customer, if the balance that you have is higher than what the customer's books and records show. Right? So so you're starting with the accounts receivable and selecting customer accounts. As a result, you're going to have to perform other tests for understatements. It's difficult to expand the sample if your initial conclusion is to reject the account balance. Right? So what are you going to do? Go back? You could, now you're going to confirm a lot more. So you have to, there's some, for the efficiency, there's some trade-offs that you're making. You have to think about how you're going to handle accounts with zero or negative balances. Right? So an auditor in that case might look at those accounts separately. So again, we have, and you won't have these in your books, but I'll provide you with these when we go over examples, or if we have example, and also with the exam, and I'll talk about that next week. But whatever tables you need, I will provide with the exam. Okay. So in using the AICPA tables again, the things you're going to look at is the ratio of your expected to tolerable misstatements. So you have an expectation about the amount of misstatement in a particular account, and you also have your tolerable misstatement that was calculated as a result or allocated to this particular account from your planning materiality. You're also going to look at your tolerable misstatements as a percentage of the population, right? And then you're going to find using the tables, you're going to find the appropriate risk of incorrect acceptance, the appropriate ratio of expected to tolerable misstatement, and then basically you're similar to the tables for over and under reliance, you're going to follow the columns and the rows and come up with the correct number. Yes, Jimmy?
I know you said that you're going to talk about the exam next class, but so that means that we're going to be needing US and F6 and F7.
Right, whatever you need when it's, you will have I provide in the exam, right? You don't need to bring in any calculators or anything like that. Same thing. You'll just find the information using the table. So whatever tables you need to complete the problem, I'll include.